Hey, what's going on, guys? This is Ordonez Method Podcast. My name is Adon Ordonez. I'm here with my sister Camilla, and we are going to talk about assets and liabilities today, a topic that is pretty well known. If you read the book Rich Dad Poor Dad, you've probably heard the terms before, but we just want to tackle it in a little bit more in depth. So I'm with my sister Camilla. Camilla, say hi.
Hi. Yeah, so today we're going to be talking about assets and liabilities in real estate and just finance in general so that you guys have a more in-depth concept of it. I recently just learned about assets versus liabilities more in depth. I always knew what they were, but there's a lot of misconceptions and things that people don't know. So today we're going to go through 7 different segments to kind of explain assets versus liabilities in general, and then also um, in real estate, which is our main focus. So, going into segment 1, I'm just going to define assets versus liabilities really quickly. So, assets are things that put money in your pocket, and liabilities are things that take money out of your pocket for short. So, there's different basic examples like assets being real estate, stocks, businesses, and liabilities could be like loans and different things like that. So I'm going to let my brother dig in a little bit deeper to that.
Yeah, so thanks, Camilla, for explaining a little bit of what we're doing. So assets and liabilities, like I said, it's been kind of like being a dead horse. People always talk about it, and it's pretty well explained. Like I said before, if you go to Rich Dad Poor Dad, you can get a very good explanation of it. But the way that I would explain it is an asset is something that's gonna pay you to own it. Okay, so if I own, in our case, if we own rental real estate, we own single family homes, duplexes, a few multifamily properties. We bought those properties, or we bought the construction, or we own we paid for them, and now we own them, and so we pay for them at the beginning, and they pay us back over time. So let's say I own a home, and my mortgage payment for it is $1,000 a month, but my rental payment is $500 a month. Then I earn $500 a month, which is the difference between the mortgage payment and between the rent that the tenants pay me. This is important to understand because this is what's going to create what's called cash flow. And we'll talk about cash flow a little bit more later today, but this is the beginning of what we call pillow money. You don't have to work for your money. And when you don't have to work for your money, you have time to do what it is that you want. You have time to go enjoy your hobbies. You have time to spend with your family. You have time to start new businesses or really focus on your passion. So owning assets and knowing what an asset is kind of the beginning of your journey into a healthy financial situation. A liability, on the other hand, is something that, like Camilla said, is going to take money out of your pocket. So something that I'm going to pay and is going to make me poorer over time. The premier example for this is a car that is not used for business purposes. You buy this car, you pay, let's say, $50,000 for it. You're driving it around, and you have to pay for gas, you have to pay for insurance, all this stuff. And so at the end of the month, your net balance is going to be negative. So you might be down $500 if you own a car. Whereas if you own a property, if you do the math right and your rent payment is less, if your rental income is less than the mortgage, you will actually be in the positive. So those are just two very simple examples. These are examples that are used quite a bit in books and videos. So at the end of the day, it's just assets put money in your pocket, liabilities take money out of your pocket. Camille, you have anything to
Yeah.
add?
So like he was saying, buying real estate is a great asset because over time you're going to get cash flow and things like that. So going on into the next segment, we're going to talk about just real estate as an asset in general. Obviously, that's our primary asset class. That's what we do full time. So real estate is a really valuable asset, and it's really good because there's a lot of benefits like it appreciates in value over time. There's like different tax benefits, and obviously you get your cash flow every month if you rent it out, so you get the income from that. So my brother's going to go a little bit deeper into that and talk about his different real estate assets.
Yeah, so we primarily, the main asset that we own as individuals, as a family, is real estate. And so real estate is an asset, and the way that we define assets is not in the accounting sense for anybody that's an accountant or studying accounting, is more of like a conceptual sense, where, like I said, assets put money in your pocket, liabilities take money out of your pocket. So real estate is a valuable asset because there's layers to it. You can earn rental income from it, but you can also get tax deductions from it, which make your earned income higher than it is, right? So if I'm a real estate professional and I own real estate and I'm earning rental income from it, I can actually claim depreciation on my properties. And through this depreciation, you send a form into the IRS, you send the form in. This is not financial advice, by the way, but this is what we do. We get with our accountant, we figure out how much we could depreciate the property by, and in turn, that ends up reducing part of our taxes. So if we had to pay $30,000 now a year, now we might only have to pay $25,000 through our real estate. It's not that you're not going to pay any taxes. There's cases where you don't pay any taxes. And we certainly, last year was an example, we didn't pay any taxes at all because we had enough real estate to depreciate to offset all of our taxes. But this is not something that you should take for granted. It's not something you're going to have every single year. But that's what makes real estate really valuable, is that one, you have the potential for cash flow, right? So that's, like I said, when your rental income exceeds your mortgage payment, that's cash flow. It's money that you're generating without having to work for it. And not only that, but you also get tax benefits from it through depreciation, mostly. I want to talk a little bit about how owning property generates rental income. I might sound like a broken record for people that are a little bit more advanced, but I really want to cater to those people who are just getting started. So basically, you buy a property. You can buy properties in many different ways. You can buy them cash. You could use a loan. The main way that we do it, we finance 70 or 80% of the home through a bank, and we put down a down payment of 20% when we're buying. If we're building, we're taking a construction loan. We'll talk about that down the road, how we structure that. But basically, we're putting in 20% of what the property costs. If the property costs $100,000, we're putting in $20,000, and the bank is lending us the rest. But for the bank to lend us, they obviously have to make money somehow. So we have to make what's called a mortgage payment. So every month, the bank charges us whatever payment it is. Maybe it might be $1,000, it might be $2,000, depending on the value of the home and the loan that you get. And we have to pay them every month. So in order to protect ourselves from being in the negative, from the home being a liability, we go out and find a tenant. We find Camilla, who wants to rent a house. And we know that our mortgage payment is $1,000. We know that our expenses, because there's expenses to owning a home, if there's any repairs, any maintenance. So let's say my expenses are $100. So now I'm at $1,100. And let's say that I have to pay for insurance. That's another $100. So I know my all-in costs of this real estate asset, this property, is $1,200 a month. That's how much I have to pay a month in order to own this property. I find Camilla, who's willing to pay me $1,500, and I rent the property out to her. She lives there. I have somebody manage it. And at the end of the month, they gave me a check of $300 because that's the difference. If you have a property management company, it might be a little bit less than $300 because they might charge you a small fee in order to manage the property. But at the end of the day, you want to be positive. You want to be in the positive column. You want to earn more than you spend on this house is the bottom line. So right now, just to give an example, I built a duplex. I have multiple properties, but one of them happens to be a duplex, and I built it myself. with the help of others. Obviously, I didn't build it just myself, but I pay $2,200 a month for it. For it, like after I refinanced it, we'll talk about refinancing later, how it works. Uh, but I refinanced it. My monthly payment to the bank is $2,200. I rent it out for each unit. I rent out for $2,000. So my income is 4,000 minus the 2,200 in mortgage plus about another 500 in other expenses such as insurance and repairs. So I'm all in 2,700, but my income is 4,000. So I end up making $1,300 a month of cash flow. Okay. I end up actually taking about 1,100 home after my property management fees. But that's just an example of how you can really use an asset to start funding your financial security, your financial freedom. Is if you have enough of these assets or a big enough one, you don't have to work for money anymore. You have the money coming in and you can do whatever it is that you want with your life because money's not an issue. Sorry, I
Yeah.
kind of went on a tangent there, but just want to get it out of the way.
Yeah, so like you said, getting valuable assets is really important just so that your money's actually working for you and you're not working for your money. And when I was first getting started, when learning about assets versus liabilities, I had a lot of different misconceptions about both of them. Like the basic example of like the luxury car or like the big house, and how some people will think that these are assets, but if you're paying them off every month and they're very expensive, then they're not always going to be assets. And also the fact that not all assets and liabilities are created equal, because there could be things like different loans for education or mortgages that you're paying off that are not the same liabilities as like a luxury car. So, do you want to explain more of that?
Right. So that's the third segment, which we're debunking common misconceptions. So Camilo's talking about not all assets are created equal and not all liabilities are created equal as well. So on the asset side, you might have a really old house that is an asset right now, but it keeps breaking down. You need to keep repairing it. And so at the end of the day, 3 or 4 years from now, it's actually going to turn into a liability. And that's not something we want. That's something we want to sell or demolish and build something new because you want an asset to keep producing money for you with minimal upkeep and just with potential of appreciation in the future. If it's a home that's falling down, and that's like what we call a problem property, that's not something that you want, even though we would consider it an asset at that point. And same thing goes for liabilities. Like I said, like maybe a college education, you could turn that into an asset, not conceptually, but you could use that education that you got in college or, doing a course where you're spending money and you're not getting anything back, but that could be an asset down the road where when you apply those skills and that knowledge that you acquired and you use it to earn income. So it's not that the liability and assets are it's kind of is positive and negative, but they can also be neutral in the sense that they're not always good or bad. It just depends like how you're using them. Um, Another like a misconception that there is of for assets and liabilities is like Camilla said, like if you you have like a fancy car, okay, that's definitely a liability. But if you have a fancy car and then you're renting it out on an app or you're using it for Uber, like it could be an asset in a sense. Conceptually, though, you want the asset to make money for you while you sleep. You don't want to have to work to make money. You want to own this asset and have it pay you. So examples of that would be real estate, as we said. It could also be like a dividend paying stock where you own the stock and they give you a certain percentage back every month or every year. I don't know too many stocks, but I know that there are dividend paying stocks. There's also, for example, some kind of software that you build that you're offering. We have a software that we're developing right now. It's a real estate budget calculator to figure out your construction costs. We're going to roll that out and we're going to have people have a subscription for it. And it's very minimal upkeep. I have a development team that's helping me upkeep it. I don't have to work all day in order to maintain it, but people are still paying me because I own that software. So that's an example of an asset that's not real estate in that sense. So Camille, you move on to segment 4.
Yeah. Okay, so segment 4, we're going to talk about cash flow, like we said earlier. So, the basis of getting rental cash flow is having the rental income exceed the expenses. So, your taxes, your mortgage, your costs for everything. And this is really important because, like my brother said, you want the money to come in while you're sleeping, and you don't want to have to work for that. So, yeah, do you want to get more into that?
Cash flow is probably next to the property being in good condition and just being like a good property. Once you have a good property, the most important thing is cash flow. If you're renting the property, um, if there's no cash flow, there's no business. There's times when you can break even or even lose a little bit in cash flow where you're losing money every month, but still offset it through taxes where you're not actually losing money. But most of the time, you want your property cash flow, and that's very important. When we do all of our underwritings, which underwriting means we're estimating what the property is going, how it's going to perform. Basically, how much money are we going to earn off this property? The last, the last number that we check, the most important one is cash flow. You know, what percentage? If we have $10,000 invested in the deal, how much are we getting back as a percentage? And we'll talk as well about that. We have a lot of good stuff coming up, but rental income is going to contribute. It's just the most important thing. That's why you own real estate. It's for rental income. Aside from if you're not going to live in it, if you're going to rent it out, you need cash flow, whether it's a short-term rental and you're renting it out on Airbnb where you might have more cash flow, or if it's just a long-term cash flow play where you're renting it out, you know, on a year-by-year contract to tenants, you're gonna focus on the number. You know, how much are you bringing in per month? How much are you bringing in per year? And that's really gonna be the important thing. If you have a negative cash flow property, I highly suggest that you probably did the underwriting wrong, something took a turn in the market, or you just don't really know what you're doing. So that's cash flow.
Yeah, so like you said, cash flow is one of the most important things to think about and really a basis of if you're making money or not. So we're gonna go into segment 5 now, and this one I don't really know too much about just because real estate's my main asset class, but it's about building a portfolio of different assets. So obviously there's other assets other than real estate. Anything could really be an asset, but different things like gold or stocks and how those can contribute to financially growing and really just
Right.
learning about them at least.
Yeah, I have a few points on that. So one thing that I really want to hit on is people want to invest, okay? And people they want to be investors. There's ways to invest for people who are employees. There's ways to invest for people who are business owners. There's ways to invest if you're either of them. But you need you need a main source of income first to be able to even invest. If you are unemployed or you don't own a business, you're not going to be able to invest. You know, people want to learn how to invest before they learn how to make money. So if you don't have any income, I suggest you learn how to do that first. And we will also be talking about that at some point. But you know, if you have an employment, you have to figure out a way to save it so you can invest it. If you have a business, you have to figure out a way to grow it so you can have enough income so that you can invest. So once you have this money, you want to invest it. And for us, our situation is a little unique because our business has to do with an investment. So we can directly invest in our business in a sense. We can directly build our own homes and buy our own homes as part of our business. And so it kind of ties together. But for a lot of people, a lot of you guys listening, you guys might have a job or guys might have a business that's not real estate. So what you're going to want to do is with the extra money that you have, you want to invest it, and you can invest it in, it doesn't have to be just real estate. It could be real estate. It's a great asset. It's a great vehicle of to produce wealth. but it could also be like stocks. Like I have some mutual funds that I invested every month, and mutual funds are historically safe. They give you a solid return. It's not as good as real estate return wise, but it's pretty steady and it's diversified in case something goes wrong with the economy. You kind of have a hedge. Uh, you protect yourself against different things, because sometimes the real estate market might crash and the stock market might not. So you're kind of balancing the risk in that sense. But there's other things like I said, you can have like your own software that you invest in and you create, and then you offer that out. So if you have different types of assets, you're more protected. But with that being said, the most important thing is to make income. If you don't have any income, you can't invest. You're not going to be a professional investor. Everybody that's an investor has some type of income that where they first got it. When I first started, I wasn't investing right away. I was building homes and I was flipping homes in order to make money. I was working a job in order to make money. And then with that money that I made, I invested it back into my business and into my investments. So that's how I'm able to have a few properties now.
Yeah, so like he was saying, there's a lot of different asset classes, some being more liquid than others. And I feel like a lot of people talk about diversifying, which is really good, but also you want to have your main source if you're just starting out. You can't just take no money and put it into all of these different things and expect all of it to, go up.
One more note
Um,
on this, one more note I kind of want to make is if you're going to invest in anything before you make any money, invest in your education. And I don't just mean education like college or formal education. I mean like your financial education. Instead of putting 15 bucks in whatever crap stock you want, go buy a book and learn how to make money. Go to a course, learn how to make money, and with that, by investing in yourself, you'll be able to later invest in assets.
yeah, and by doing that, you're actually going to know about what you're doing, not just mindlessly going into it and being like, oh, I have this extra money. Let me just put it anywhere.
Correct.
But yeah, going into the sixth segment, it's going to be identifying liabilities in real estate. So obviously with real estate, there's a lot of expenses that can become liabilities. Different things like taxes, maintenance cost, all of those things. And we're going to be talking about how to reduce those, not reduce necessarily, but just know like your underwriting and see what kind of liabilities you're going to face so that your real estate can become an asset to you.
Yeah, so you want to be aware of the different expenses that you're going to have within real estate that can make it an asset or liability. So like I said before, when you buy a property, if you finance it, if you buy it all cash, if you just have a check for $100,000 and you buy it, you're only going to have a few expense related items. You're going to have any maintenance of the home, insurance, and taxes. You're going to have to pay that. Okay. Now, if you finance the home, which is how most people buy property, you use the bank's money and then put in a percentage yourself. You're going to have all those expenses like insurance, taxes, and repairs, but you're also going to have a mortgage payment. Okay. And it's going to be what's called PITI. So it's going to be the principal and the interest that you're going to have to pay on the loan. And that together ends up being your mortgage payment. And there's lots of different ways to structure these mortgage payments. There's lots of terms. It's very confusing. It would take like a whole segment on itself, but you want to know what that end number is that you have to pay per month. So the most important thing is to keep those things in mind. The mortgage, if you finance in the mortgage, and then whether you finance it or not, the taxes, the insurance, and the maintenance costs. If you know those numbers and you make sure that your rental income is more than those numbers, you're gonna be okay, barring some crazy scenario where the house burns or something crazy. But if you know those numbers, your property will remain an asset as long as your rental income is higher. But you're not going to rent your house for less than what you bought it for. And there's ways to know ahead of time how much you can rent your property for, so you can make a good estimate. So that's why you have to educate yourself.
Yeah. And with that, going into the last segment, you really want to know about what you're getting yourself into with any of the asset classes and really just understanding what you're doing. So the seventh segment is going to be tips for making informed decisions. And like we were talking about earlier, you don't want to just go into these asset classes and just mindlessly throw your money around. You want to know exactly where your money is going and what the process is going to be. And I read this book recently by Kim Kiyosaki. It was called Rich Woman. It's really good for all the ladies out there. But it was kind of, one example was had to do with stocks, and it was like, if you don't know exactly how the company that you're putting your money for the stock into, if you don't know exactly how they're making their product or like exactly how they're getting their money, then don't invest your money into it. It's better for you to know more about like what you're doing and put your money into the education first before just doing it mindlessly. So yeah, my brother has a couple more tips, but I just wanted to start off with that.
That's a great point, Camilla. It's like being informed. I would say first and foremost, when you're investing in any financial decision, first you want to get educated. Okay, so you want to, like I said, you want to read books, listen to this podcast, listen to other podcasts, uh, get a mentor, very important. Get somebody who's done it before, get them to teach you the ropes. Any type of education, courses, events. There's so much education out there. Like go out there, get educated, get your feet wet. So that's the first thing. The second thing is, like Camille said, get informed. Like, what are you investing in? That kind of goes hand in hand with education, but it's a different type of education. It's not financial education. It's more of a specific education. Like, what is this home that I'm buying? What does it entail? Where is it? Who's renting it? What repairs? What mortgage will it have? Get informed on what it is that you're buying. If you're buying a stock, what company is it? How do they make money? What are their numbers? Okay. So get educated, get informed, and then get investing. Like you're not going to learn until you try, right? So once you know what you're doing, you have a little bit of extra money, invest it. Whether it's a mutual fund, whether it's in real estate, if you have like a decent chunk of change, which you don't really need too much. You know, you can find properties at a good price. We're about to start offering, we're about to start building container properties, which are going to be about half of the price of our single family homes right now, which are very, very accessible to really anybody. So there's many ways that you can invest, but you have to. It's like when you go to the gym. You have to get in the gym of investing. Okay, so if you're in the gym of training your body, you're gonna get stronger, but you're gonna have to fail a little bit. You're gonna have to drop some weights. Okay, it's a process. So if you get into the gym of investing, you might lose a little bit, you might win. You want to make sure you have calculated risk so you don't lose everything. But in the end, we learn through failure. So get educated, get informed, get investing.
Yeah, so like he was saying, you're not gonna just, you have to fail first. And like starting to invest in all of these different things, like for houses, you may find a really good deal and have to work a lot harder on it just because it was a really good deal. But that's going to show you all the ropes of doing everything yourself. So you can't just start off and just excel right away. You kind of have to just go through it and learn just like everyone else did. So
Camilla,
we hope that,
so yeah, to wrap up, can you just run through the 7 segments again for those people who may have missed what they were about, for those that are
yeah.
taking notes?
So the first segment was defining assets and liabilities. We kind of just explained what they were. And then segment two, real estate as an asset, which again is our main asset class and what we do full time. The third segment is debunking common misconceptions that people like you or me may have heard before from just talking to different people. And then segment four, the very important role of cash flow and how it's going to help you a lot in the long run. And then segment five, building a portfolio, which could be through many different asset classes and diversifying if you wanted to. Segment six, identifying liabilities in real estate, different expenses that can come up and knowing how to generate cash flow from that. And then lastly, tips for making informed decisions so that you're going into it with the straight mind of what you're going to do.
Right. And the last segment comes with the three little tips of get educated, get informed, and get investing. And I actually just came up with that as we spoke. So don't
It's going to be our little
yeah,
motto.
it's gonna be a little motto. I'm not gonna trademark it, but I did just come up with that. So yeah, we want to hear from you guys and what you guys like. So when this podcast or this video goes live, we like to hear comments from you, what you liked about it, what you want to hear more about, and that can help us create more content in the future. Like we said before in the first episode, this is for us a great opportunity because we're learning along with you guys. We learn a lot by teaching what we have learned, and you guys are also learning a lot because you're getting content from people who are like you that are similar ages, similar scenarios, but just have a little bit more information, which we're sharing to you guys. So, like Camille
Yeah.
said, hit like and subscribe.
Yeah, and like he said, I'm just learning about this all like pretty recently too, within the last year or so. So I'm learning just as much as a lot of you guys are. And for the more advanced people that are listening to this is just a good refresher, to refresh your mind about what assets versus liabilities are. So we really hope that you enjoyed this episode, and we will be back soon to talk about more fun things.
Very
So
fun.
yeah.
Awesome. See
Let
you
us know what
guys.
you think. Bye.